Hi there folks, welcome back to another weekly general update, and this will be the final one for 2011. Now we've had a pretty eventful week. It looked like we were building up for a rally into Christmas, and that really got punctured in the week that's just been with some fairly negative market action around the world. So I'm going to have a good look at all the relevant charts and what the next couple of weeks and the next couple of months are likely to hold for us. First of all, just a reminder that this is general advice only. Now, a bit of a summary of the action for the week. The S&P index closed down 3.2%, which was about 40 points. So that's a pretty reasonable move. It had been pushing up against resistance at 1265, 1267, and looked like it was going to break through that level, but eventually that resistance held and the price came off fairly quickly. Over the last couple of days, the market had got oversold. It had a chance to rebound, but really struggled a couple of times, and we'll have a look at the chart on that. So to me, the tone in the market globally has changed quite abruptly in a week. If we go back to the 30th of November, when we had the central bank coordinated action by the central banks, things looked very positive. We ran along in a very positive way. The market seemed to ignore bad news and just wanted to go up, and that now has pretty abruptly changed, I think. So for me, I've been drawing out two alternative scenarios, one where we could see the market move back into a more bullish mode for a period of time, or one where we would resume the downtrend, the bear market that I believe started in April of this year. I think that bearish scenario now looks far more likely. Just looking at the global scene, it's looking less like Europe will be able to fund the summit outcomes when people start to analyse what exactly the summit resolutions contained and what it is that individual governments need to do. It's looking less and less likely that they're actually going to be able to do that. Corporate profit guidance has started to come down in the US. Some of the major companies and I'm talking, top 30 stocks, Dow Jones stocks, are now starting to reduce their earnings guidance. The Chinese stock market continues to send some pretty worrying signs. A key support level has broken, and so that's not a great sign. And I believe that the US Federal Reserve is probably going to have to do most of the heavy lifting to avoid a pretty calamitous situation in Europe. So expect to see plenty from the Fed in the next quarter. So to me, as I've been saying for quite a few months now, money printing looks inevitable, but I also think it won't occur until markets fall perhaps sharply further and start to look desperate, and that really forces the hand of the central banks to do more in that regard. The ASX 200 closed 1% lower for the week, so again, just a bit of a timing difference. We're not really doing that much better than the US. But I think looking at all the signs and the way that the patterns are unfolding at the moment, I think our major resource stocks and bank stocks are looking vulnerable. You've got to remember we're only 2% of the global stock market, and when overseas investors want to sell out of Australia, it can have quite a substantial impact on our market. Now gold fell $112 on the week, and this was really forced liquidation selling, and it would appear to have been linked to this MF Global collapse and the liquidation process that's happening there. So we had a triangle formation that was looking like it would break to the upside. That's failed. We're still holding the long-term trend line, which is above 1560, and we did have a pretty sound reversal from oversold on Friday night. So at this stage, just working on what we can see rather than on what some doom and gloom merchants are telling us could happen. We're still in uptrend, and gold is still looking pretty solid. There's been a number of people that have jumped on the bandwagon and started pointing to the fact that gold's now broken this magical 200-day moving average, which a lot of technical analysts jump on. If their theory is if prices are above the 200-day moving average, we've got an uptrend. If they're below the 200-day moving average, we've got a downtrend. I think these people are just all participating in a very limited view group thinking process, and they're not really looking at the facts. So we'll have a look at some of the facts around what's happened with gold, because gold has broken that 200-day moving average on many occasions during the last decade, and it hasn't stopped the upward run. Now, silver was also lower on the week, about $2.70 on the week, but also did a nice little rebound on Friday night as well. And other commodities fell also. And this largely in commodities and stocks was largely a euro weakness, US dollar currency story. I don't believe there's a whole heap of massive selling off of commodities at this stage because of fear of a global recession. I think it's largely a currency impact. So let's go over and have a look at a few of the key charts, and we'll come back to the presentation. Now, I want to start with currencies because this really is dictating where markets are going at the moment. This is the euro US dollar currency, and I wrote about a month ago that two of the key signs I was looking for was a break of around about $1.31 on the euro, which of course happened in the last week, and also looking at Italian 10-year bond yields. If they were to head above 7% and continue in a rising direction, then that would be extremely bad for stock markets as well. So we've had the euro US dollar break below 131. It is oversold, so we might get a little bit of a blip for a few days, but to my way of thinking, this is in downtrend. The ultimate test will be when we break, well, if we break this level here, which at the moment it's at 129, but that's certainly not looking good. You can see if you look at the moving averages, the red line and the green line, quite clearly the euro is heading lower. Now let's look at this in a slightly different way, and that's looking at the US dollar index, which is against a basket of currencies, but heavily influenced by the euro. As you know, big picture, the US dollar has been in very substantial decline for some time against a basket of currencies, so we can see that over the last decade. Now over the last, let's say, since 2008, so over the last 3 years, the US dollar has really just been in a quite a volatile sideways move. You can see some very sharp angles on those moves. Now it appeared to me that we formed a double top here, so let's just pan back in. We formed a double top here, which was the 3rd of October, and again on the 25th of November. And the expectation was that the US dollar would fall, continue to fall. Now, last week we actually broke above that, and so that now opens up the possibility for a move back towards perhaps 83.5 or even closer to 89. Now, the US dollar has been going in the exact opposite direction to stock markets. So if the US dollar is going to rise over the next few months, this is not going to be great for stock markets. I'm not saying that will happen, but certainly now we now have higher highs and higher lows. So on what we can see at the moment, the US dollar is in uptrend. I don't know how long it'll last, but whilst the US dollar is in uptrend, that is not good for commodities and not good for stock markets either. Now let's have a look at the S&P index. Now you can see here we bounced off these lows the 28th of November. We got up to this 1267 level, and basically have just stalled there. We've come back down again last week. Thursday and Friday had two goes at moving upwards, but both of those you can see closed way off their highs. So not looking particularly robust, I have to say. Now let's look at the two scenarios I've been talking about. One scenario, let me pan back one. You can see here we've got an upper trend line and we've got a lower trend line here, and that's defining a pretty big picture triangular wedge pattern. Within that we can also draw a shorter term one, which is this one just here, running through the highs of October and December. And so we're really looking for resolution, whether we move up to the top of this triangle and then head back down. I think that is the more likely scenario, but it is possible that we could continue to move up and down within this triangle and then eventually break out. But for me, a new bull market requires a close above 1310 or 1320 at this stage. Let's have a look at our market, and we're really just following along, just going sideways, fairly volatile, and no real trend there at all. Now the other chart that I wanted to take a look at was the Shanghai index. So I've pointed this out before. This line here, this 2320 line, was really quite important because it was picking up a number of high and low points in the market. We had touch points in August 08, October of 08, February of 09. We had several here through April, again in July of last year, and then a couple more this year. So the breaking of that support line is really quite critical. Now the market fell sharply for 4 or 5 days, got oversold. We're getting a bit of a rebound, so that's normal. We may rebound back towards that breakdown level, but that's not a great sign at all. Let's move on and have a look at gold. Now I mentioned that a lot of technical analysts have been getting all excited about the fact that gold has broken this 200-day moving average, which is the purple line. I'll zero in on this just a minute, but I just want to pan back and point something out here. Let's go all the way back to the start of this bull market run, which was in the year 2000, and it's not all that clear on this view, so let me move in a little bit closer. And you can see there's been a few occasions when the when the gold price has broken below this 200-day moving average. Here it is in April 2003. It was below there for a couple of weeks, and then very quickly resumed its very strong uptrend. Again in May of 2004, it bobbed up and down, but whilst it remained below the 200-day moving average for a period of a couple of months, it didn't actually fall very far, and then it just kept forming higher highs and higher lows. So no real drama there. Happened again here in May of 2005, but again just really the decline was fairly minor, and it was only from the high point there. We got to a high of 456. We formed a low of 413, so it was only $40 an ounce at that stage. Roll forward, and we had another episode here in 2006. But again, the gold price didn't really fall all that far once it went below the 200-day moving average. We had another little one here in 2007. So you can see there's been many occasions when the 200-day moving average has been breached. Now let's roll on to 2008. We had certainly had a significant liquidation fall in in 2008. But once we hit the bottom, which was October, the market then moved up very, very strongly, and was by February of 2009 we were clearly at new all-time highs. So we roll forward now to the current time, and you can see we've just breached that 200-day moving average now, and a lot of people are saying the bull market in gold is all over. Well, clearly, if you look back over the last 10 years, that's just a silly thing to say. We might go down a bit further yet, and let me pan back and have a look at perhaps one scenario, and that would be if we look at the whole run, which started back here in October of 2008. You can see we've got a very clear trend line. We got close to that trend line on Thursday and Friday night, but we didn't breach it. And if we have a look at, put our Fibonacci structure on that run from October of 2008, you can see we've got three main retracement levels coming in at 1438, 1294 and 1150. Now, personally, I don't believe that we would go much below 38.2 because this trend in gold has been so strong that I would be very surprised if we came back below that. However, when you've got liquidation selling going on, anything is possible because you don't really know how much of it there is to be done. But what I can say is that if you look at the RSI, we're now down at a level that we haven't been at since the bottom in 2008. So there's an awful lot of reasons why gold is going to head a lot higher. A lot of fundamental reasons. It's really just a matter of where is the bottom, and that's why, from a strategy perspective, just taking it careful for the moment until we see what actually transpires with gold over the next couple of weeks and months. But certainly my view of gold hasn't changed one little bit. Now, similarly, silver, we had not a bad reversal on Thursday and it followed through on Friday, so silver not looking too bad either. So let's go back to the rest of the presentation. This is the Italian 10-year bond yield. You can see we did get a sharp decline early in December when the central banks all coordinated action, and it fell very sharply from about 7.3 to about 5.8. But now that there's been a rethink on what that actually means, the bond yields are starting to head back up again fairly sharply. So if it continues back up over 7, then you're going to see some very sharp reaction in financial markets. Just a bit of a big picture comment that I covered in the written part of the alerts this weekend. As a big picture view, I believe we're entering into a multi-decade deleveraging as a social attitude, if you like, and therefore it's not going to turn around quickly. We had 4 decades of using our house as an ATM and borrowing against what we believed would be an ever-increasing asset value. And I think there's a reasonable chance that appreciation of assets over time may go into a reverse for a period. So I think we're now in for a few decades of a bit of a reverse attitude, and people will be looking to pay down debt and to save a lot more. So this will have an impact on property and stock valuations. I'm not predicting a crash or doom and gloom, but I'm just saying I think the expectation that house prices go up by 10% a year on average is going to be severely dented. The fact that stock markets as a whole go up year after year is going to be severely dented. So I think it really requires a bit of a rethink whether you're an investor or a trader. The second part is really I think we're going into a period of significant disinflation due to the aging of the baby boomers, who predominantly, and this is a global Western economy phenomenon, they're going to have inadequate savings for retirement. Governments aren't going to be able to afford to meet the pensions that have been promised. And so the retiring baby boomers are going to have a lot less disposable income than they previously expected. And so I think we're going to see spending fall quite dramatically. That's going to affect company profits and hence the stock market. And the third area, of course, is developed world debt levels. They're completely unsustainable, but it's a real rock and a hard place situation because they've got to get their debt levels down, but you cannot get your debt levels down and grow your economy at the same time. So I think we are going to have a series of rolling recessions over the next decade as these excessive debt levels get wound back. So for me, my message to investors in particular is just forget the buy and hold strategy for the next 5 to 10, maybe 20 years. It just is not going to work. You're going to have to be an active manager of whatever you do. Now within that, there's going to be fabulous opportunities. There'll be powerful rallies that will last for 6 months or a year or possibly even longer. So there'll be tremendous opportunities to make money, but not by buying and holding. Now, just a final couple of things on gold. Just from a supply and demand point of view, it's really clear to me that gold is starting to come back as a form of money, and that movement, that theme, if you like, will continue to gather speed and momentum. Central bank buying has really accelerated this year, and particularly in the third quarter, the last numbers I saw from the World Gold Council, central bank buying is up massively, and that's going to continue to increase. Mine production is no way going to be able to keep up with it, and so we're going to see significantly higher gold prices. Sort of some of the technical indicators, we looked at that before: 1438, 1294, and 1150. It's possible the main trend line could break if this liquidation of gold has got some more to play out yet. But look, if the main trend line was to break, which is at around about 1560 at the moment, then I would be surprised if gold went below 1438, and I think that excursion will be very brief. So if we look after the 2008 liquidation, gold made a new high within 3 months, and gold stocks soared by anywhere from 100% to 1000% and more. So that's why I'm so excited about the next 3 to 6 to 12 months. As long as we position ourselves well, without much exposure, and we buy some of these panic sell-offs, I think 2012 is just going to be a fabulous year for us. So the actions to take with respect to the Christmas rally, it's highly unlikely now. It's possible we still might get a few days of rebound, but look, I think the risks just don't justify the rewards at the moment. So I'm keeping a very low profile. Our focus needs to be on buying well oversold levels. I don't really want to buy just good entries. I want to get great entries. And into 2012, I expect a pretty volatile first quarter. I'm really expecting January to be more negative than positive. And I think markets will continue to react badly until money printing is forced upon the central banks. Trading the ranges will still be a key focus. It's not going to be all in the downwards direction. We are going to get plenty of ups and downs, because when you look at some of the Australian stocks, you look at BHP and Rio trading on price earnings multiples of 8. We've got the Australian banks, and whilst I think they're going to struggle into the future, they still are attractive to many people because they're paying dividend yields of 7% plus. So I think, yes, there will be sharp sell-offs, but equally there will be sharp rebounds as well. So looking to trade the ranges, and of course gold producers are going to outperform pretty much all other parts of the market. I think they'll do absolutely brilliantly over the next year, but we want to gain as much advantage as we can and just buy the panic sell-offs. So that's it for this week. It's a much longer video than normal, but I had a lot to say. But just in closing for 2011, it's been a tough 6 months. A lot of unexpected things happened, and it's certainly given me an opportunity to reevaluate how we can best make money out of this market. And it's not by being in the market all the time. It's by being very selective, being patient, grabbing the good opportunities at the extremes as they come along, and then taking those profits and getting back out of the market again fairly quickly. That's the way we're going to play things in 2012. And for members, there's a lot more information coming on enhanced training and a bit of a different process in how I actually communicate the trading signals to you. So that's it for 2011. We'll catch up with you next year. Cheers.